Hi, my name is Jordan Wilson. In episode 34, we discussed a bit as to why active asset management has a very hard time outperforming its benchmark, achieving alpha. And if that's the case, it probably does not make a lot of sense for investors to pursue active management strategies or to invest their capital into funds or other products that actively manage the portfolios. And we did see some areas where there might be some consistent excess returns, but overall not a lot. We also talked a bit about investor costs, and that's a big driver for the lack of the active return, whether those costs be sales commissions. So an investor up front is buying a fund and having to pay for that privilege, or the management expense ratios, or just the costs involved with getting active management timing wrong, making the wrong decisions on when the market's shifting or when to jump into a specific stock or to exit another. So that's what we looked at last time. Today I just want to go through a little bit of data, sort of flesh out what we discussed on a more of a broad level. One of the things we talked about was the shift to no-load funds. We discussed that when we looked at mutual fund fees and sales commissions. And one of the things I said was we're seeing a shift to no loads from loads. This graph, courtesy of the 2020 investment company fact book, looks at the level of net assets held in long-term mutual funds. And the first thing we note is that in 2010, there was about 9 trillion US in these funds. 9 years later, 17.7 trillion. So we're seeing that there's been a almost 100% increase in assets in long-term mutual funds. And I think that's partly because they're effective investments for investors. There's a ton of competition and new products that have been offered in the last 20 years, covering every market niche possible. So it's easy to create your own target asset allocation as customized as you'd like. I think another factor in this is that over time we've seen a huge shift and a continuing shift of defined benefit pension plans to defined contribution pension plans. And overwhelmingly, defined contribution pension plans offer their plan participants, the employees, say, of a company that's a member, a range of mutual funds to invest in that are either directly managed by the plan sponsor or delegated out to somebody else. So as we see a shift more and more from defined benefit plans into defined contribution, that's probably a factor in the increase as well. The second thing to note here is that while assets in mutual funds have almost doubled in 10 years, if we look at the load funds, they stayed pretty flat, 2.35 trillion in 2010, 2.33 trillion in 2019. So in 2010, the load funds made up about 26% of all assets. But by 2019, that had fallen by half to only 13%. Whereas on the NoLoad funds, they were 56% at 5 trillion. And in 2019, they were 12.7 trillion, or 72% of all the assets. And that says people have shifted from load to unload. Because I'm presuming that not everyone that's in a load in 2010 just sat there. So you're probably going to see some shift. Either that, or everyone that bought mutual funds since 2010 just sat there and put it into NoLoad funds. And then plus you factor in any growth in the assets just organically through increases due to returns in the portfolio. And that suggests even more exits from the load funds. And I think an issue there is, why have people moved from load to no load? Well, I think one of the things we may have discussed back in the sales commission discussion was that there's no correlation, studies have found, between paying for a load and a no-load fund in the net performance of the fund itself. Now, loads are their cost to you as an investor. If I spend $1,000 on a mutual fund that has a 5% front load, I'm only getting $950 left to actually invest in the fund. So I'm starting out at a big deficit. But just on an ongoing basis, you would expect that if I'm paying a premium to invest in your fund company's load fund, that there should be outperformance relative to a no load fund in that same asset class or subclass. So again, if I'm paying a 5% load for the privilege of owning your product, it had better outperform similar products in the same asset classes that I don't pay a load for. Why would I pay $950 when I could get my full value of $1,000, unless those other funds are going to perform better over the long haul? So there's some statistical evidence just from consumers voting with their feet that perhaps load funds do not outperform, and the academic studies correlate with that. The second point I'd made previously when we looked at sales commissions is that back-end loads, which were never large to begin with, they're almost down to 0 by 2019. So very, very small on a relative basis. So again, just some interesting data in this slide, which sort of says, probably don't buy a load fund. And again, my caveat there is, when we discuss sales commissions, is that often your management expense ratio will differ between a load and a no load fund. So just make sure that it's an apples to apples analysis, that if you go into the no load version of a specific fund, that you're not paying a jacked up MER to compensate for that with the fund salespeople, because they need to get paid and it has to come from someplace. We also talked a lot about management expense ratios. That's the management fee on the fund, the administration of the fund, the back office expenses, the accounting, the regulatory filings, shareholder communications, marketing of the fund. So the advertising you see on TV, that's a cost of the fund. And the trading costs, the transaction costs when they buy and sell investments. If we look at this slide again from the 2020 fact book, There's a few interesting points on this, and this is 2019 data. So if we go to the far right column, equity funds, on average, simple average, we add up all the equity funds, MERs, divide by the number of funds, that gives us an average, just a rough mean. 1.24% is the average cost for an equity mutual fund in the United States. But if we drill down a bit, we sort of see what I'd also talked about was the more complex or the more niche the market that you're investing in, the more work that's required by the asset managers, maybe the more trading costs, maybe there's more regulatory work if you're dealing in a different area of the world or a niche market. And what we see here is a blend, that sort of value stocks, growth stocks. So S&P 500, let's say, 1.02. It's lower than the average. And then as we move into increasing complexity, for example, the world is more complex, less developed, less transparent than the United States, your costs have risen to 1.31. If we look at individual sectors where I have to drill down into pharmaceuticals or consumer staples, again, maybe I have to do more work at a smaller level. We see 1.37 in the sectors. Similarly, if we look at the bonds, the average bond mutual fund, 0.93. But for investment grade or government bonds, which are a little bit more, probably bigger companies or, again, there's better information, the investment grade is 0.78, government bonds 0.85. And then as we move down, say, to the municipal level, maybe slightly less information for the city of Phoenix versus the US government or the Canadian government. You see the costs creeping up, 0.88. High yield, some people would call them junk bonds. Again, probably less quality information out there, 1.06. And similarly with the equities, the world market requires a little bit more work, especially if you're residing in Wall Street or Bay Street in Toronto. And the world is 1.11. So you see a little bit of a correlation in the fees as we discussed before. The other thing to note here is the second column from the right is the asset weighted average MERs. And what they've done here is they're adding up all the MERs and dividing by the population, just as with the simple, but they're weighting the MERs. So the funds that are large have a higher weighting in the MER average calculation. And part of that is very useful because, as we spoke, the bigger a fund goes, they can spread out their fixed costs over a wider and wider investor base. And that's what this is. This is your MER per investor. So if I'm paying $1 million to a fund manager for their expertise, and I've got $1 million in assets, then it's, 1. But if I've got 10 million, it suddenly drops to 0.1. And that's what makes this a little bit more useful to look at. And we see here that the bigger funds, when you factor in their weights, it drops the equities from 1.24 down to 0.52. I think this also tells us a bit as well that there's a correlation between popularity or success of a fund and its fees. Another thing that we've talked about in the past is that a big predictor of future success is the fees of a fund. And again, what we're seeing here is that the less expensive funds are the ones that are attracting investor capital. So they become big, and yes, there's the economy of scale factor, but there's also a factor that because they're less expensive, that's attracting shareholder capital over the higher priced funds. And even here, we also see a bit of a correlation between the complexity of the fund assets and the MER. So 0.52 was the average, but for a blend, 0.31. Again, US blended stocks, fairly easy to analyze, trade, it's liquid markets. Then we go up to the world, and it's over twice that much to 0.64. So again, those are kind of interesting things that I find on this slide. And they juxtapose, or I should say, they connect well with what we've discussed just in general about how fees are important. And there's a question as to whether you should be paying loads and these sort of things. This is also a good slide, and it's on expense ratios, a comparison between actively managed and index funds. Now, we've seen over time that since 2000, both active and index fund prices have fallen. Part of that's due to economies of scale as assets grow. We've seen since 2010 mutual fund assets have doubled, so that should reduce at least the fixed cost component. But also there's been more competition in the funds, more offerings, and a lot more use of the low-cost index funds for investors. Now, if I'm a actively managed equity fund charging 1%, and someone can get an index fund at 0.27 back in the year 2000, I have to generate like 125 basis points of excess return to stay ahead in my net performance calculations. And I think when we talked on returns, there isn't that alpha. So the only thing that active managers can really do is tighten up and try to reduce their costs, because the lower the cost base they have, the less excess return they have to generate to match that benchmark. But even today, you're looking at 0.2% that the active managers have to outperform on the equity side. And if we look, considering these are US stocks, over the long haul, the S&P probably returns about 8% on average yearly. So if your benchmark roughly is 8% per year, and you've already got to pick up another 10% just to beat that, again, you're starting in the hole, and it becomes difficult. And again, you see a delta as well at 0.56 to 0.07 for the bond funds. So much cheaper. And if cost is the big indicator of future success, that's another reason to go into index funds over actively managed. And again, just to sort of throw out one more statistic that we looked at in a prior session, is we saw that, I think it was over 10 years, that mutual funds only outperform their benchmark 23% of the time for when we looked at all of them. So can you successfully pick that 23% that outperforms? That's also questionable. Market timing we discussed in the last episode. How, to me, that's a cost of doing business, is getting it wrong. And it's also a potential opportunity if you get it right. But this is a couple of interesting slides. The first slide here is from Morningstar, and they're looking at the cost of missing very few of the best days over a 20-year period. So if you had invested in the index fund from 2000 to 2019, your average return would have been 6.1%. And there's 5,035 trading days in that period. Had you only missed 10 of those days, so you're trying to sort of say, I'm going to pick the top and the bottom of the markets, or in 2016, the night that Donald Trump was elected president of the United States, everyone was saying, sell, 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 this is the end of days. If I said, I'm going to sell, 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 you missed a strong boost subsequent to his election. Similarly, after 9/11, you saw a nice rebound in share prices after the crash. So if you don't have the ability to get it exactly right, and you only missed 10 of the best days of the market because you thought the market was going down and you didn't jump back in yet, 10 out of 5,000 days, your return falls to 2.4% from 6. If you miss 30 or 40 or 50 of the best days, and 50 out of 5,000, that's not very many. You know, that's like 1%. You're suddenly losing money just because you weren't invested on those days that the markets did well. So it's just funny that people think they can market time, but they don't factor in just the simple fact that if you miss 1 or 2 days here or there in a 1 or 3 or 5 year period, that can have significant impact on your portfolio. And I don't think that even factors in the transaction costs when you're buying and selling as you jump around. This other slide is courtesy of Fidelity. And what they look at is over almost a 40-year period from 1980 to 2018. You invested $10,000 in the S&P 500 index, January 1, 1980. If you let that sit there and accumulate, December 31, 2018, you've got $659,515 in your portfolio. Not bad. Now, that's 13,870 days. Almost 14,000 days. If you had just missed the 5 best days, your portfolio would only be worth 427,000. Your overall accumulation would be down 35%. If you missed the 10 best days, your accumulation would be 318,000, down 52%. If you missed the 50 best days, 50 out of 13,870, you'd have ended up with 57,000 instead of 659,000. 91% decrease. So that's your potential opportunity or market timing costs if you aren't exactly correct in your market timing. And you can be pretty darn good because it doesn't take much to miss out on 5 days where you just got it slightly wrong. And maybe you only got in halfway through the day. You saw the markets had turned at 8 a.m., 9 a.m. in the morning, and you decide, oh, I didn't get my buy order in until noon. So that also impacts. So some interesting statistics just to sort of back up our discussion on why active investing may not be optimal and definitely doesn't adhere to what we would think intuitively, where these are experts. This is their training, their technical skills. They have access to the tools, the information, the companies. They have the experience. They do this 11 hours a day. So if anyone can get it right, it's them. But there's other factors in play that make it difficult to allow them to outperform. And again, if overwhelmingly they can't outperform, why should you pay for that privilege of the underperformance? One thing I will quickly say on the previous slides is that obviously huge deltas in your accumulated wealth if you miss out on 5 or 10 or 50 days in the last 5,000 or 14,000 days. Now, I'm not going to present any slides, but obviously there's down days in there as well where you're fully invested if you're an index holder. And at some of those points, the asset managers will make some correct decisions, not on identifying when the bottom hits and possibly missing out on those big increase days, but maybe they'll have jumped out before a market correction downwards. Now, there's still validity to those two slides, but that explains why you're not seeing those huge 91% corrections between, or adjustments or variances between the passive performance accumulation and active. I would say that when you knock out all the pluses and minuses where they get it right while the passive is holding the index versus when they get it wrong, is that brings it down to sort of that 5-day, 10-day period. So it's, there's pluses and minuses, but on average, they probably miss more than they get it right versus the person that just holds the fund for the entire 40-year period. That's all basically I wanted to discuss on this. Just show some data, try to parse it a bit and figure out what does this mean, and based on what we've discussed in the past, and how you should consider it when you start looking at future investments. Maybe I don't need a load fund. Maybe I don't need that active management fund. Or at least it'll help you investigate. If I'm paying a load, I'd better be getting very, very strong returns. If I'm buying active management, is it a closet index fund because it's grown so big that it has no agility? Look at its holdings. Look at its performance versus its benchmark over time. And that'll help you decide is, yes, this is one of those 23% of funds that's worth my time and energy to invest in. And if not, maybe I should just stick with an index fund. Thanks for listening today. Have yourself a good one.